case briefs, and so much more. LSData's got what you're looking for.
In 1951, the United States Court of Appeals for the Seventh Circuit heard the case of Bloomington Coca-Cola Bottling Company v. Commissioner. The case centered on Section 112, B1, of the Internal Revenue Code, which states that a taxpayer can only recognize gains or losses when properties are exchanged for other properties of like kind, not when exchanged for money only. The dispute arose when a taxpayer sold their old bottling plant for $8,000 in 1939 and claimed a loss of $18,811.34 on their income tax return. The commissioner subsequently adjusted the taxpayer's average base period net income for 1939, removing the perceived $22,886.79 loss. The taxpayer argued that the transaction fell under Section 112(b)(1) of the Internal Revenue Code. However, the tax court held that it was a sale resulting in a recognizable loss, not an exchange of like property. The appeal came after the taxpayer had built a new plant in 1939, transferring their old buildings and land to the contractor for $8,000 upon completion. The taxpayer's 1943 and 1944 excess profits tax return show the 1939 base period. Excess profits net income to be $2,278.25, with a net capital loss of $2,000 used in computing line 1. Ultimately, the court determined that the taxpayer's claim of a loss from abandoning the property was unsupported by convincing proof of intention to abandon and discard it. The transaction was deemed a sale, not an exchange under Section 112(b)(1) of the Revenue Act, and the tax court decision was upheld.
Case briefs, and so much more. LSData's got what you're looking for. Visit lsd.law, elevate your mind, leave the stress of class.